Welcome to the Deep Dive. We're Talk Tickers, and today we're cutting into the recent fiscal year 2025 Q3 financials for SideChannel. That's ticker OTCQB SDCH.
Yep, we're sifting through their August 13th earnings calls. CEO Brian Hooley, CFO Ryan Polk. We want to pull out the key signals.
Exactly. Our mission today is really to get past those headline numbers. They look a little soft, maybe.
Yeah.
But is there real strategic momentum underneath towards that higher value software revenue?
That's the question. So let's kick off with the snapshot. Quarter ended June 30th, 2025.
Okay, headline numbers. Revenue, $1.8 million.
Right. And that's actually down 3.8% compared to last year.
And the GPS? Basically zero, right?
Yeah.
Came from a net operating loss of $261,000 for the quarter.
Yeah, pretty much zero EPS. And this is where the nuance kicks in. For a microcap focused on growth like this, a small loss, it often means the EPS rounds to zero anyway.
So the market kind of shrugs it off.
Sort of. It wasn't a surprise loss. It was more like the expected cost of making this big strategic shift they're attempting, investing in the future.
Okay. And that small loss came with some margin pressure, too. Gross margin landed at 47.0%.
Which is down, about 190 basis points year over year.
So 1.9 percentage points lower. It's noticeable. Bit of a squeeze there.
It is. But look at how the market reacted right after the call. The stock, it barely budged the next day. Closed up, 0.7%?
Tiny move.
Tiny, which tells you the market is being, let's say, constructively patient. They're not hitting the panic button over that services dip.
They're waiting to see if management can actually pull off this pivot, which sounds kind of painful, honestly.
It often is. So the market's looking past the quarter's churn, focusing on the operational dynamics underneath, which gets us into the real financial deep dive.
Right. So that 3.8% revenue dip year over year, you said mostly driven by losing VCIO clients.
Primarily, yeah. It seems planned, or at least accepted, but it's still messy when you see it in the numbers. That's the older, lower margin business they're trying to move away from. It's shrinking.
But here's the counterbalance, the signal you were looking for.
This is it. That drop in services was partly offset by pretty healthy growth, 22.8% year over year in revenue from their cybersecurity software and services portfolio.
Okay, so they're swapping out the old for the new.
Successfully, it seems. Trading shrinking legacy revenue for growing higher potential streams.
Okay, but that transition, that move towards software, that's what hit the margins we mentioned.
Exactly. That 47% gross margin was getting squeezed from two directions. First, lower employee utilization. I mean, if you're shrinking the old services side, you're going to have people temporarily idle, right?
Makes sense. And the second pressure point.
This one's maybe a bit more concerning short term anyway. It was more revenue coming from lower margin third-party software and services.
So reselling other people's stuff.
Basically. So while overall software sales are up, if a chunk of that is just reselling, the margin they capture right away is lower.
But there's a tailwind here too, you said.
Yeah.
Their own software, Enclave.
Yes, Enclave. Management was pretty clear on this. The adoption of their higher margin Enclave software helped offset some of that third-party drag.
So it suggests that, okay, they're paying a price now with lower margins, but the future looks better if Enclave really takes off.
That's the bet. The future margin profile should improve quite a bit as Enclave scales.
Okay, so if margins are shrinking today, where's the money going? To speed up that future margin improvement, presumably.
That takes us right to OPEX. Operating expenses. They rose 4.5% year over year.
And management owned that increase.
Explicitly, they said it was intentional, driven by significant bumps in selling and marketing spend, specifically to push Enclave.
Investing to grow the core product, targeting certain sectors.
High-value sectors, yeah. They're spending aggressively now to grab market share for their own software.
It makes sense. Trading today's margin for, hopefully, high-quality recurring software revenue tomorrow. But you got to have a stable base to do that, right?
Absolutely. You can't just spend aggressively if the floor is shaky.
So how's the balance sheet holding up into this spending?
Seems stable. Cash and short-term investments were $1.2 million at the end of June. And crucially for a microcap like this,
Let me guess. Debt.
zero debt. They made a point of saying that. And management also mentioned minimal cash burn, suggesting they don't see an immediate need to raise more capital.
Okay, so that gives them some stability during this pivot phase. It sounds tricky.
It definitely is. Looking wider, the year-to-date numbers, so for the 9 months, revenue's $5.6 million. That's actually up 1.3% year over year.
Oh, slightly up year to date then.
Yeah, and year-to-date gross margin is 47.5%. As for looking ahead, no formal numbers, no guidance. They just said the focus is on executing these strategic moves.
All right, so let's shift from the numbers to the strategy itself. This is where Enclave comes in big time, right? Their zero trust platform.
It's the key differentiator. Their big bet for future growth.
You hear zero trust everywhere in cybersecurity. Just quickly, what does that mean for like a government client? Why is it important?
Well, think of the old way, right? Like a castle. Hard shell, maybe a firewall, but once you were inside, everyone was kind of trusted.
Okay.
Zero trust throws that out. It means you strictly verify every user, every device for every single connection. Doesn't matter if they're inside or outside the network, you trust nothing, verify everything.
Essential for sensitive data, then.
Absolutely essential, especially for clients handling regulated data like government agencies.
And the CEO really emphasized that federal angle, specifically the Department of Defense.
Doubling down on it, he said. Enclave's already deployed with 2 DoD clients, and they're actively trying to expand within the DoD and into other regulated sectors.
That DoD traction feels like a big deal.
It's arguably the single most important data point in the whole call. Federal sales cycles, they take forever, notoriously long.
Right.
But once you land a contract, they tend to be sticky, high value, and honestly, they act as huge validation. If your tech works for the DoD, it signals it works anywhere.
Okay, so that explains why they might tolerate some margin pressure now for a shot at major federal revenue later.
Precisely. It's a calculated risk.
And supporting that federal push, they also launched something new, an insider threat service.
Yeah, they announced it around DEF CON 33. They even brought in a new VP to lead it, which shows they're serious.
Okay, and the strategy there?
Really, client interest seems okay, but the clever part is the plan. They want to integrate Enclave into the service, create a unique, bundled solution using their own zero trust tech.
Ah, so not just selling services, but embedding their product, making it stickier.
That's the goal. Own the solution, not just the service delivery.
Okay, but let's inject some, skepticism here. We talked about shedding VCIO, so client, but their trailing 12-month revenue retention is pretty low, 61.4% as of June 30th.
Oof, yeah. 61.4% TTM retention that's very low. Best-in-class SaaS companies, they often aim for 120% or even higher through expansion.
And 61% means?
It means they're definitely losing clients faster than they're growing revenue from the ones that stay. Either clients are leaving, going out of business, finding other options. It just highlights why this pivot away from relying solely on those VCIO services is so urgent.
Okay, so how do they plan to fix that? Just better account management?
Well, that's part of it. They talked about focusing on account management to stay sticky, trying to upsell those VCIO clients into higher margin stuff like engineering services, cloud security, especially Enclave.
But can better account management really fix a 61% retention number? Or is that just talk?
It's probably a bit of both. Account management is definitely necessary. You can't ignore it. But the real sustainable fix for that low number has to be successful product adoption.
Enclave needs to work.
Enclave needs to land and expand within accounts, not just replace clients who are going to leave anyway. The market's definitely going to watch that retention metric like a hawk to see if the Enclave strategy actually starts to stabilize things.
Okay, that definitely sets up the investor context section. The Q&A seemed to clear up some fog around certain issues, didn't it?
Yeah, it offered quite a bit of clarity. First big one was about Enclave pricing. There was this idea floating around.
The $50 number.
Yeah, this $50 per agent per month number that investors seem to have latched onto, which, if true, would just make it way too expensive, uncompetitive.
And the reality.
They clarified. Enclave is modular. It's priced per agent per month, yes, but the range is generally more like $3.75 to $7 per agent per month.
Ah, quite a difference.
Huge difference. And it depends on volume, bulk discounts and which modules you bundle together, asset intelligence, secure web gateway, certificate management, segmentation, things like that.
So basically, they're priced competitively. Puts that $50 thing to bed.
Hopefully. It was a needed clarification, frankly. A bit of relief for investors, probably.
Okay, another point was about their 8K filings. Why not announce every single win to show momentum?
Management's take was interesting. They said they're being subjective about it. They prioritize announcing the really meaningful stuff, the showcase deals.
Like the DoD wins.
Exactly. Or the insider threat launch, key partnerships, things that really move the needle strategically. They said they want to avoid looking like a PR factory, just churning out noise without real substance.
Plus, the nature of the business, right? Cybersecurity clients are often sensitive.
Very. Clients often ask not to be named. They mention the DoD agencies, obviously, but also a large Arizona City client. That kind of non-disclosure naturally limits how much they can publicly brag about sales wins. It shapes their filing strategy.
Got it. Okay, shifting back to the financials, they also addressed something called the Polson relationship. Sounded like some legacy baggage investors were worried about.
Yeah, it seemed like a perceived financial drain, some kind of ongoing cost.
And the story there. It's a good one for showing they're cleaning house.
It really is. They clarified it's not a cash drain now. It's a remaining deferred cost asset on the books from way back in 2021. It was a stock-only consulting deal, 4 years long, and it actually started before the current CEO was even there.
So inherited issue, no cash going out today.
Right. And the key point, that remaining deferred cost, it gets fully amortized down to zero in Q4 FY25. So by the end of this fiscal year, next quarter basically, this legacy thing just vanishes from the books, shows they're tidying up.
Nice. That cleanup leads nicely into another potentially valuable asset, net operating losses, NOLs, complex but important.
Hugely important potential asset for a company trying to get profitable.
How big are we talking?
They have $7.5 million in federal and state NOL carryforwards. That's as of September 30, 2024.
Okay, for those of us not fluent in tax goo, what does having $7.5 million in NOLs actually mean for SideChannel down the road?
It means basically they've got $7.5 million worth of past losses they can use to shield future profits from taxes. Yeah, once they achieve sustained profitability, they could potentially earn $7.5 million in profit before they have to pay any federal or state income tax on it.
Wow. Okay. That's a significant boost to early earnings when they get there.
It's massive. It changes how you might think about tolerating some near-term losses if it fuels the growth to unlock that tax asset later. It's not on the balance sheet yet, but it's waiting.
And finally, on transparency. They talked about breaking out Enclave revenue separately.
They did. They said they're preparing to do it to show its contribution more clearly separate from the broader software services bucket.
But not yet.
Not yet. They said they haven't crossed their own internal threshold for materiality to do that. So it signals, yes, Enclave is growing, it's real, but it's still a relatively small percentage of the total revenue right now. Growing, but starting from a small base.
Okay, this feels like the right place for our required segment. This is not financial advice. We need that outrageous but plausible trade idea.
All right. The thinking starts with performance. The stock's actually done well over the past year, up 73%. That crushes the broader cyber ETF, HACPK, which is only up about 27%.
So investors are already giving them some credit, despite the messy quarter.
It seems like it. Credit for the strategic moves, probably those DoD wins specifically. The market's showing some faith in management, even with the microcap volatility.
Okay, so what's the high-risk, high-reward catalyst trade here?
The pitch, and remember, not financial advice, is maybe a highly leveraged long position in SDCH before the Q4 earnings call. That's expected around December 3rd, 2025.
Leveraged long. Pure speculation then. Betting on one specific thing.
Pretty much. It's a bet entirely on a single high-impact catalyst materializing in that Q4 report.
And that catalyst is betting on Uncle Sam paying off.
You got it. The trade really hinges on them announcing a significant expansion within those existing two DoD clients, like multi-agency, multi-unit expansion. Something that proves the land and expand model is working big time in federal.
That would be huge validation.
Massive. Or alternatively, maybe the catalyst is the first measurable annual recurring revenue, ARR, coming from that new insider SREP program, showing it got traction fast.
So it's a high-risk gamble that the federal sales cycle finally delivers the big win where the new product hits the ground running.
Exactly. A bet on a major step up in pipeline conversion, basically. High risk, potentially high reward if it hits.
Okay, so wrapping this up, SideChannel is clearly in the middle of a tough pivot, juggling the decline in VCIO services while spending aggressively to grow Enclave, especially in that federal space.
Yeah, the core takeaway feels like the market is, for now, giving management the benefit of the doubt, letting them play the long game.
Which leads to the final thought for you, the listener, to chew on. Considering everything that $7.5 million NOL asset, the zero debt balance sheet, how much near-term margin pain should you as an investor be willing to put up with?
Especially if you believe each dollar of that increased OPEX, that spending, is genuinely driving adoption of their software inside these really sensitive, high-value federal accounts.
That margin sacrifice today, funded by a clean balance sheet, that really is the central trade-off this quarter highlights.
Definitely something to think about. We encourage you to consider all this, apply your own analysis.
And we'll catch you on the next deep dive.